Thank you so much. It is my great honor to welcome my panelists, and I'm really pleased to be a moderator for this insightful conversation on collective wealth and democratizing investments through pooled funds. I'm joined by a group of exceptional professionals across the capital markets. I'm joined by Mr. Oladele Akinjo from Ashtec Investment Manager, Cedrus Group, and Mr. Anthony from Trade and Development Bank, Mr. Victor Avevor from Ghana, Ashfield Investment Managers Ltd. Last but not least, our lady, our only lady, Miss Hanna Teshome, a senior legal advisor at the Ethiopian Capital Market Authority. So this session is aimed at exploring the possibility of the collective investment schemes and how can they expand financial inclusion and open an alternative avenue to build wealth for Ethiopians. So thank you so much for joining me in this panel. And just to kickstart with our discussion, I'd like to direct my question to Ms. Hanna first, our regulator. So to kickstart our conversation, collective investment schemes can be a tricky concept for some retail investors. And let's start with you giving us an overview about the concept of collective investment schemes, what they are, and what operational elements are needed to implement CISs in our jurisdiction, and where are we as a country on implementing CISs? Thank you.
Okay, thank you very much, Yared. Collective investment schemes. So I think people that have been following the capital market evolution and development in Ethiopia know that this is a topic I've been talking about for the past 4 years. But I think perhaps one of the reasons for having this conversation for so long is because the concept of collective investment schemes, while simple, is also quite complicated. Now, it's simple in the sense that collective investment schemes really just represent a different way of investing. So we're all accustomed to investing directly, say, in a share or in a bond. In the case of a collective investment scheme, what we do is we invest in that share or bond or other asset, but in a more indirect way. And it's that indirect way, which is what we call the fund, that is really, in essence, what a collective investment scheme is. So collective investment schemes are funds. These are arrangements that allow us to invest in many different kinds of assets through this vehicle. Now, funds in some jurisdictions, in the US, for example, they're called mutual funds. We have hedge funds. We have PE funds, so private equity funds, some which operate in Ethiopia. We have VC funds. So these are the more startup types of companies, funds that invest in startup types of companies. So collective investment schemes really is a broad-based way to name a wide range of funds. When we talk about a fund, we're talking about an arrangement that is structured using a legal form or a legal mechanism. And this legal mechanism, in many instances, is what gives the different kinds of names under the umbrella of collective investment schemes. So this morning we heard our regulator from Uganda, Josephine, we heard her talking about open-ended funds that have proliferated in Uganda, for example. So collective investment schemes also encompass arrangements that we would otherwise not see in the direct investing structure. So we have mechanisms where we invest in an investment company, and we have that investment company invest in other types of assets, whether it's real estate, shares, bonds, whatever the case may be, and then we own a share in that. The open-ended investment that Josephine mentioned is more of an arrangement where we buy and sell and we can exchange as we wish. So it's more of a flexible way of investing. Now, I know this sounds, that's the complicated bit because I'm mentioning many different names to explain what collective investment schemes are. I've mentioned the fact that it goes by many different names. But overall, a collective investment scheme is that arrangement. And what we're looking to do, you asked me about the status of collective investment schemes. Perhaps let me take a step back. A necessary component for collective investment schemes are professionals. So a collective investment scheme would be an arrangement that has professionals undertaking this investment activity, does the investments on behalf of investors. There's also security that's provided to investors by having other people hold the assets and manage the assets, and normally we have custodians for that purpose. So in terms of having key components for collective investment schemes in Ethiopia, a key component would be having these necessary professionals in place to help undertake the activity of investment. You asked about the status of collective investment schemes and the regulatory framework in Ethiopia. And the reason I'm mentioning the professionals required first is because, as you know, we have a licensing framework for the various professionals. So in order to first even acknowledge or start thinking through the regulatory framework for collective investment schemes, we need to think about who are these professionals that actually undertake or manage these activities. And we have the licensing framework for that, and we're looking at building out the professional ecosystem to provide these services to the funds. Why don't I stop here, Yared, and then I'll continue the question after the rest of the professionals have answered.
Thank you. That's actually an excellent definition. That's kind of you actually use this as a foundation to set the rest of our conversation. Let me actually direct my question to Mr. Victor. Ghana is actually becoming and increasingly becoming an active CIS market, and I would like to hear your perspective on what are the benefits of having investment funds and pooled investments in the capital markets.
All right. Thank you, Yared. And then thanks, everyone, for making it here. And congratulations to the ECMA for organizing this informative session for us to share knowledge. So CIS is a retail product. And the whole essence is to make it possible for retailers who usually don't have the large sums of money to be also able to access markets through smaller ticket sizes. So your typical retail investor may not be able to access a variety of asset classes, a variety of sectors, even geographically diversification. They would not typically have the financing to be able to do that. So in order to give that sort of access to the retail investors, that is why pooled funds like CISs are important. And like my colleague panelist just said, there are various types and various structures. Common ones are the mutual funds. In Ghana, we also have unit trust, and the difference is around governance, where the mutual funds have their own board. They are set up as an institution with their own board, although they are run by a fund manager. But a unit trust have a board of trustees, which is normally a bank that then seeks the interest of the trust holders or the unit holders. So one key point is diversification because the pooled funds give access. The other thing, which was also insinuated by my colleague panelists, is the fact that it is managed by professionals. So professionals or professional fund managers who research markets, who manage risk, and also seek to optimize returns. So that is an added advantage, which a retail investor may typically not be able to do, even if they are financially savvy, they may not have the time to do that. So giving the money or deploying the money through a professional asset manager then gives them that benefit. There are also low barriers to entry. And so your typical share price or unit price for a CIS is low. So a retail investor would have access to multiple asset classes, multiple products by just buying a unit into a fund, as compared to doing a single stock investing. So for example, if I wanted to, for example, buy Wegagen stock, I'd have to put up 1,000 bear. I just checked this when we went for the coffee break. It was 1,000 bear yesterday. It's gonna buy 20 additional points, so 1,020. Whereas a typical unit trust or a mutual fund will cost way lower, maybe as low as $1, which is about 160 bear. So you realize that it's the tick sizes are small in terms of the price, and so it's easy for retail investors to go in. It's also retail products like the CISs are also good for financial inclusion. So for emerging markets such as Ethiopia, it is one way of reaching out and getting the mass population, which is dominated by the youth, as I've come to see. The median age of the population in Ethiopia is 20, which is very young. And so these are the young people that you want to start bringing into the market so that then they grow with the market even as you're starting. So that's another advantage on that. Financial inclusion, you get young people, you get more people to come in, and then they also have access to to benefit from the returns on the capital market. Another thing, which also was insinuated by my colleague panelists, is that these funds are regulated. And because your market is new, it is a very essential aspect of it, that investors realize that products are regulated, and it is a way of building trust as the market evolves. Regulators are there to check fund managers, and so it's some sort of collaboration that has to work together to give them confidence to grow. CISs thrive on demographics, which is something that Ethiopia has. Population is large. Your investable or your population that can invest is also large, and so this sort of synergy is something that you can leverage, or participants in the market can leverage to grow wealth, both for the retail investors and for the fund managers. But there are challenges, and some of these challenges are low financial literacy. Because it's a retail product, typical retail investors don't understand the market that much. And so participants would have to invest in education so that, in Ghana or where I work, we call it educon. So you educate and then you convert. And it has to be an ongoing process. More like what was said by the governor yesterday, the CEO of the EIH, it's going to be a continuous process where you constantly are educating. And mind you, as you are educating, you are also innovating. So there are going to be new products as you go along. So it's going to be a continuous process of educating and converting their retail investors. There are also challenges around distribution. For most emerging markets, there are manual processes involved in KYC, investing, making redemptions. And so these are barriers that, as participant or as a market, you have to be taken into cognizant. So digitization is one of the ways to cure some of these issues. In some sense as well, regulation can be a challenge where, because of investor protection, regulators want to see more and more. And so market participants also have to bear that burden of compliance, which is good, but comes at a cost. So, I think I'll end it here, and then as the conversations evolve, I'll add more to it, Yared. Thank you.
Thank you so much, Mr. Victor. I liked how you shaped the question in terms of how pooled funds can be utilized in terms of investor education, professional management, and access to a diversified asset classes in the capital market. Given these benefits, I'd like to direct my question to Mr. Oladele. So I would like to ask, what was the early catalyzers that helped incentivize millions of investors in your jurisdiction to participate in collective investment schemes?
Thanks, Yared. Good afternoon, everyone. It's great to be here, and congratulations to the ECMA team for putting this together. I think the previous speaker has actually touched on some of the things that are salient and important lessons that we can pick across different markets. And I think just to provide context, for Nigeria today, the CIS market is around $4 billion. It's grew by about 172% since 2023. As at 2023 was $1.2 billion thereabout. And there are, structural and, distribution incentives that are come to play a critical role in that. And some of which is, one is the two previous speakers touched on regulation. Having a very strong fundamental regulation is key. So regulation around fund management license, around separation of responsibility between the fund manager, the custodian, who actually holds the assets, and also the trustee that ensure compliance with, the regulations and the trustee. And I think one of the other things that is just also critical and might be something to consider here in Ethiopia is that having a structural regulation around what we call bankruptcy remote structures, where through the clear separation of responsibilities of parties, you can separate the risk of the fund manager from the fund itself. The unit holders are the owners of the assets, and that assets sit with a custodian. That ensures that in the event, for example, the fund manager has some financial challenges or bankruptcy issues, it does not affect the unit holders. What this does is that it galvanizes investors' confidence in the markets. Because investors see these clear regulations, it sends a strong signal, not just to local investors or retail investors, but actually international investors that are strong regulations that are in place. And I'm glad that our regulator, SEC, is here. I know you guys are working very closely with them. So leveraging on the market participant and experience of regulators like SEC in Nigeria will be very fundamental. I think that is critical. That is the foundation. Victor, I hope I got that right, touched also on having attractive products. And I think having an accessible product, it's a way to really attract retail investors. In Nigeria, one of the key game changers for us that we've seen is around money market funds. Money market fund, as at today, I think contribute about 46% of the CIS market. And the reason is simple. It's easy to access. So low-income earners, the teachers, the students, with $5, with $10, you can actually buy this product. So it's a way to attract retail investors into the market. But that is not enough. Like Victor said, education and conversion is also critical to go side by side with that. The third thing, again, is just around distribution. In the last few years, we've seen remarkable growth in the fintech industry in Nigeria. The banks are now acting as distribution channels. The fintech companies, telecom operators, and even platforms like USSD are now able to easily attract people to, just open an account, buy a mutual fund, be able to track their investment, be able to make investment into the mutual fund, be able to redeem their investment. And, when you're able to do that, it just gives you as a retail investor a lot of confidence around portfolio management. You're seeing how your portfolio is performing. But what has really galvanized that is technology and fintech. And I think that's something that needs to go side by side with what you're doing here. What that has done essentially is that it has moved the role of traditional stockbrokers into the hands of millions of Nigerians who are now able to tap into that sector. And I think the other thing that is critical and that you can consider early on is just around disclosure requirements. In Nigeria, depending on the kind of funds that you're managing as a fund manager, our regulator make it mandatory that you have daily reportings, quarterly reportings, monthly reportings, and having, just fund fact sheets available to market participants to see how your fund is performing, having audited accounts and annual quarterly meetings to report on these things are critical in boosting investor confidence. I think at the retail level, if you just look at that from regulation to distribution to having attractive products and just ensuring there are a lot of disclosures around, the way the market works in a way that a retail investor can understand, can follow through. I think it would attract, quite a lot of retail investors into that space. And I think just briefly on the institutional side of it, I know you haven't asked, but what we have also, what will be fundamental as you put together the structure that you're laying out is to think about regulations that can attract institutional investors. One of those things is having clarity around fund repatriation. In Nigeria today, when you invest and you bring in fund into Nigeria, investors, institutional investors get something that is called certificate of capital importation. What that does essentially is that it gives you access at the point of whether it's dividend distribution or repatriation of your capital. It's easy for you to be able to attract and take your money out of the country. So from an institutional point of view, when you're looking at foreign investors, that's just something to consider as well. I'll stop there. I think maybe later I can add more to this. Thank you.
Thank you so much. You answered my question very robustly in terms of the factors that enables investors in terms of accessible products, technology that enables flexibility of investors to participate in those funds, and most critically the regulations and the regulatory frameworks in place around fund repatriation can ensure and boost investors' confidence. Let's actually extend this question to Mr. Anthony and hear the Kenyan perspective. What are the early catalyzers from your jurisdiction that helped retail investors participate in pooled investments?
Thank you so much, Yared. I think, and good morning, good afternoon, and also allow me to congratulate ECMA for a very great conference for the second year in a row. Well done, Hanna and your team. I fully agree with what my colleagues here have said about what are the basics, catalysts for a very successful and well-managed collective investment industry, or the CIS industry, and its power in democratizing capital markets and ownership of investment vehicles. I think the same 5 things have led to a very aggressive collective investment industry in Kenya. And I should say actually in East Africa, especially the 3 countries, Kenya, Uganda, and Tanzania, and to some extent in Rwanda. And Ethiopia is very fortunate, is neighbors to all these countries. They don't have to make the mistakes which these countries have made. The Kenyan collective investment scheme industry has done well, I must admit. It's of course 25 years old, started late in 2000 or 1999 there. And personally, I've been fortunate. I've been around in those 25 years as a market player or as a leader in institutions which have issued and managed those collective investment schemes. Currently, the CIS industry, for example, in Kenya, the AUM is surprisingly, I'm shocked, it's slightly bigger than Nigeria, given the demographic differences. Kenya just has under 55 million people, and Nigeria is as populous as Ethiopia or more. Currently, around $5 billion assets under management in the Kenyan collective investment industry. Full breadth of service providers. There are more than excess of 30 asset managers or fund managers offering those products. The products cut across all asset classes, from listed equities, fixed income, whether it's its money market or debt, and to also to an extent property in REITs. It's quite an enviable industry. And as been mentioned yesterday, for example, by Dr. Evans Osano from FSD Africa, it's one of the fastest growing sectors in the capital markets environment in Kenya, and I should repeat in East Africa, because Uganda, and we are fortunate, the regulator, she's here, Josephine, they're also enjoying a very stellar performance or growth in that, in the collective investment schemes. So there are some few things which have helped catalyze that growth. And I think my colleagues here, starting from Hanna, even what Victor said, has really been the same thing. And I don't want to repeat what they have said, but there are basic 5 things. One, there is a good capital markets regulator. And ECMA is almost there, and it's going to be there very soon. That has been a huge catalyst for the industry. Secondly, there's been licensed providers of those products. And those have done a very good job over the last 25 years to make sure that they provide the products in it. And then thirdly, the products themselves have quite been very responsive to investor needs in all aspects. Good products, and to currently even non-local currency products. Back in Kenya, we use the Kenyan shilling. So there are also products which are non-shilling. And I hope very soon in Ethiopia, you'll have beer unit trust, and one day you'll have foreign currency unit trust. Because you have one of the luckiest countries in the continent having a huge diaspora community, and that they can tap to those retail products. 4 has been a big catalyst, has also been the access. And by access is both, being able to invest and divest easily using technology. And then secondly, having those products in the appropriate denomination or amounts which enable a retail investor to invest easily by smaller amounts, as low as equivalent of $1. And that was said here in the earlier panel. And the access also, both electronically, physically, through your phone. Again, Ethiopia is very fortunate. It has a very advanced mobile telephony, mobile money telephony industry or capabilities. So that enables access and also enables investment divestiture. Because one of the best ways to develop a collective investment industry is to make sure people can invest easily, conveniently, and they can also divest easily and conveniently. You shouldn't worry that they can take their money anytime. Anyone who has managed a CIS fund, every morning you have people investing, and every morning you have people divesting, and that shouldn't worry you. The last part which has made the Kenyan industry, the collective investment, very successful is a factor which most players have to confront and embrace, is distribution. Collective investment schemes are just like any other commodity we use as human beings. The reason why it's the oil industry is able to do well is because it has distribution through retail outlets or petrol stations. The reason why the FMCG industry is very successful is because it has small shops, corner shops, and it has supermarkets. So also collective investment schemes require a very extensive distribution network. So institutions with that network, especially insurance companies, commercial banks, you are fortunate to use, you are lucky to have that network, and you should use that to distribute the product. It should be bought over the counter on any distribution network. We should also enable that product to be available in a shopping counter, in a supermarket, not necessarily in a financial services business. And that distribution is what has really big thing in Kenya. And the industry is on its 25th year, but I would say that growth, 70% of the growth has actually been witnessed post-COVID. So before COVID, it was just under $2 billion. Post-COVID, which is just 5 years or less now, it's heading to over $5 billion. And I think the growth should hit double that number in the next 3 to 5 years. Thank you.
Thank you so much, Mr. Anthony, for your elaborative response. Let's come back to the regulatory frameworks, to Ms. Hanna. So she actually, in her previous response, she actually told us a little bit about the regulatory frameworks. And I would like to ask, how can this regulatory framework or the CIS framework can be utilized to fostering innovation in terms of the fund management space and in the capital market? And how can it be balanced with market development and investor protection?
Okay, thank you, Yared. That is a very loaded question. Let me take a step back and talk about products, where my colleague here mentioned CIS in the context of products. In the first instance, CIS, we said, can come in many different shapes and sizes, including different kinds of asset classes. So we've heard our colleague mention the fact that you can invest in equity, bonds, listed, unlisted, and even mentioned real estate, the concept of real estate investment trusts. We're talking about a broad range of assets, and we're talking about a wide range of products. We've also mentioned that CIS, we're primarily speaking about retail investors in this conversation because we're talking about really the democratizing of investments and access to investments here. So in the case of retail investors, we're looking at, we're looking at including both retail and institutional investors in our regulatory framework. Separately, our colleague also mentioned the ability to divest from the investment itself. So the ability to take out the cash that you put into your investment, the ability to take it out whenever you need it. That's the notion of liquidity, the fundamental notion of liquidity, to be able to liquidate your investment. So taking all those things into account and creating the right kind of balance between investor type, asset class, and legal structure and framework, all of those things require a delicate balance. I believe our Director General was talking about balancing today. So again, with the CIS framework, the same notion of balancing is required. And how to get that balance right within the context of the Ethiopian legal framework, the Ethiopian status of evolution of the capital markets, all of that again requires even further balance. And I bring in then the notion of innovation at that point. So innovation and balance, all of that has to happen together within the context of clear and coherent regulatory framework. So how can we do that? How can we be enabling in our regulatory framework, provide access within the regulatory framework, allow for change and innovation and technology and fintech also, as was mentioned previously. How can we manage to do all that, yet at the same time still make sure that we are following or adhering to the principles that we are required to follow, which is to protect investors. That is one of our primary objectives, and also protect the integrity of the market. Now, there are many different ways to fine-tune a car, and there are many different ways to fine-tune a collective investment scheme regulatory framework. I think one of the primary considerations in fine-tuning the regulatory framework for collective investment schemes, and also allowing for a framework for innovation and evolution of collective investment schemes, I think an essential component is engagement with the market. When I say engagement with the market, we're talking about engaging with all levels of the market, meaning future product creators, potential market participants, making sure there is an understanding of the current environment, processes. It could even be processes of how to register a company and how to register the specific elements of a CIS. It could be, what are my roles and responsibilities as a fund manager within the Ethiopian context? So there are many different points on which we need to evolve and create a common understanding. And one of the ways of doing that is through engagement, substantial stakeholder engagement. But then the second point to incorporate a mechanism for incorporating innovation is what you've heard in today's conversations and also yesterday's conversations, and that is the idea of a sandbox sort of mindset. Let me just say sandbox mindset, because what we have in a sandbox is a regulatory safe space. This is a space where within the oversight and guidance of the regulator, there is an ability to create new ideas, ensuring that the necessary protections, investor protections are in place and market integrity considerations are taken into account. There is a chance of also doing something like this through a sandbox type of arrangement. I think overall, I'm not sure if I've answered the question in the way that you wanted it answered. I think the key point here, though, is it's about balancing the regulatory framework to keep CIS open to a wide range of participants, open to a wide range of assets, but always within the framework of ensuring that investors are adequately protected, whether it's by diversification or by legal structure or by enabling liquidity. Let me stop there.
Thank you so much, Hanna, for your insights. So in the interest of time, I think we should move on to our concluding questions. So I'm going to ask you a question for our colleagues from abroad, and please take a couple of 1 minute or two to reflect on this question. As Ethiopia builds its CIS industry from the ground up, what is the single most important lesson from your own market experience that you believe in Ethiopia must take to heart to ensure long-term success? Victor, maybe if I can begin with you.
All right. Thank you for that question. So just before the question came, I was casting my mind back to some of our experiences in Ghana. Before 2022, money market funds were valued based on amortized cost. So any investor in a money market fund was always seeing a positive trajectory. So once you're in a money market fund, you see growth, although it might be slow, depending on what market yields are. Then in 2022, our government had some sort of partial default. And so for money market instruments that held bonds, longer dated bonds that were issued by the government of Ghana, all of a sudden faced liquidity challenges. The default was in such a way that durations were extended and then yields were cut. Okay, so the regulator realized that, no, I need to look at this, because what then was happening was that if fund managers were still valuing portfolios based on amortized cost, they were invariably going to be paying people who wanted to redeem their units at values that were not going to be reflective of what the market was. So regulator came up with a directive for money market funds managers to change valuation from amortized cost and then start marking to market. And so all of a sudden, you have portfolios worth billions of cedis that were literally looking at half of the value. So I'm drawing this parallel to bring in the fact that regulation is critical. So even as Ethiopia is evolving, it will be important to have that mindset. I mean, I've heard a few panelists today and even yesterday speak about how government issuances are risk-free, but they are not. I mean, in our experiences, and in any basic finance class, we have systemic risk, and there are all sorts of risk. Government risk is not risk-free. So, and we've seen examples of that across the globe. So it will be important, even as we build the blocks, to have that in mind. What sort of valuation methodologies are you going to ask or ascribe to various funds? And even in the back of this, we've seen some fund managers who've tried to innovate by saying that they are money market funds or fixed income funds, so to put it, we're only going to hold like a year duration papers. So some of these guys have gone back to the regulator to negotiate or argue to go back to the old way of valuing the assets in the fund. So these sort of things can cause trust deficits in the market. So I would pivot around regulation, and I would say that it's critical that even at this onset, the regulator and market participants are clear on what the dynamics can be, because this can cause critical issues. Technology, innovation, those have been touched on. But know that the retail investor is sensitive. They were putting money and they're looking for short-term gains. And so there's some sort of pressure on the fund manager to deliver returns, which most CISs are tailored to grow wealth into the future. But you have retail investors who come in and are looking for returns in the shortest possible time. Retail investors also tend to want to exit their portfolios where there's market volatility. So in the example that I gave where valuation methodology was switched, you find that investors wanted to exit. So you find instances where fund managers are showing two valuation reports to clients, one that shows the mark-to-market value and the one that shows the amortized cost, just to try and explain to the clients that, well, this is the situation. Market is down, we're marking to market, but if the economy recovers, you might go back to the instances where there's that growth trajectory. So basically, I would say that education and regulation has to find a way to marry so that expectations of investors are managed, even as trust is built to see the market evolve. So I'll leave it around here.
Thank you so much, Mr. Victor. I think in the interest of time, I think it's better to wrap up our session here. Please give a round of applause for my panelists. Thank you so much.